Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. In many ways, investors are dealing with a lot of conflicting signals right now. It seems that nearly every day we're seeing signs that consumers weakening under the high cost of living, yet financial markets are back trading at all-time highs. Meanwhile, the Federal Reserve is telling us the economy's strong, yet it just cut interest rates by 50 basis points, a move we typically only see during times of extreme stress. So, which is it? Should we be preparing for better or worse conditions ahead? To find out, we turn to the experience and wisdom of financial advisor Ted Oakley, managing partner and founder of Oxbow Advisors. Ted has over 40 years experience helping clients, mostly high net worth families, protect and build wealth through good times and bad. We'll find out how he's currently positioning his client assets for the rest of the coming year. Ted, it's wonderful to see you again. Thanks so much for joining us.
You bet, Adam. Good to see you.
Oh, Ted, it's always a pleasure having you on. A lot of questions here for you. A lot of recent news to react to. But before we get to all that, let me just ask you the broad question I like to kick these discussions off with. What's your current assessment of the global economy and financial markets?
Well, Adam, you have to break the global down into two sections because if you look at it, I'll just take the world to start with, but China is really weakening a lot. I mean, it's uninvestable, I think. Germany now is becoming a really weak sister in terms of Europeans, and the EU in general is not doing all that well. Maybe the UK a little bit better, but so there's trouble all around on that end. And then on the US side, I think what's happened is we have sort of a camouflage or sort of a crust over our eyes in this respect. People look at the market and think things are okay. And one of the things that's happening is people continue to spend on services. I would have guessed a year ago that we would have had at least one or two quarters that have showed either flat to negative. We didn't get that. I think the services part of the economy pulled it forward. And then the second thing is I think the government spent obviously almost $2 trillion this year extra election year, and that's changed the dynamics quite a bit. But I don't think we're out of the slow growth look. I think I would have to agree with the great interview you did with Lacey Hunt, Dr. Lacey Hunt, and that we're talking. And I asked Lacey this: that are we like Japan? And he said to a degree, because we're going to have this huge debt you can't overcome. So it doesn't necessarily mean you go into these crazy deep recessions or something, but it means your growth is virtually nothing or 1%, and your debt just keeps going. So that's sort of where we are. So I think in the midst of that, what you have to decide in investing is how are you going to choose what you're going to own? Because the next 10 years, we really truly believe, and the last two are not like what we experienced the 12 years prior.
All right. So the salad days, basically between the global financial crisis up to 2022, pretty much over, is what you're saying, and we have to figure out how to invest for a different world. Maybe it's going to require a different playbook. Is that fair to say?
That is, and if you just take one thing, take the Dow gold ratio. I mean, if you look at it, you could buy what you could buy the Dow Jones for. And the way that ratio comes about is how many ounces of gold does it take to buy the Dow Jones? And if you look at it, it takes less today than it did 2 years ago, January 22, just like you're talking about. What that means is that you're really deflating the buying power of everything because gold is pushing that other way. And that just gives you one snapshot, but you're right on the money there.
Okay, so I want to get to the state of the consumer because I think it's tied to the point you just made there, which is yes, it may require a different playbook going forward from here. We're all kind of imperfectly trying to define exactly what that future is going to look like. But I think one of the things that we may have the greatest confidence in is that the purchasing power of the currency is going to continue to suffer, especially as we continue to have, the interventions that you mentioned, forcing liquidity in the system and whatnot. I mean, that's the price of that essentially mathematically is a decrease in the purchasing power of the currency. But before I get there, let me ask you about the big news of the week, which is that the Fed pivot is now official, right? So the last December, I mean, it's taken a long time, but last December, Powell basically said, okay, you know what, we're going to change policy here. But he kept the market basically waiting, what, 9, 10 months for that to happen. But it officially happened this past week. And as I mentioned in the intro, it wasn't just a garden variety 25 basis point rate cut. It was a 50 basis point rate cut, which historically we'd look at and say that means the Fed's worried about something. Now, Powell took great pains to say, nope, everything's great, everything's under control. This is a sign of strength that we can cut like this. But of course, that's what the Federal Reserve Chair is going to say. He's never going to say he's nervous about something. So how meaningful is the pivot? How meaningful is the 50 basis point cut? And do you think that the Fed is actually more concerned than confident here?
Well, I have to say, Adam, I probably don't know anything about what they're thinking, but I will tell you just from the outside looking in, and I will say this to you, over the last 40 years, I've looked at the market. When they would cut the Fed funds rate by 0.5 point, it would make big news, and people thought, man, there's something really wrong here. And what this brought was just a big yawn. I mean, nobody even, and that tells you where we are complacency wise. But then they came back and said that maybe the neutral rate's about 287. I think they came up with their 288, meaning they've already pushed the neutral rate higher than the 2%. I don't think they really know. And I think one of the problems they're going to have is that you're going to have supply side inflation in many areas. And if you have that at the same time that you've got a slowing of the business cycle necessarily with this deal with the worldwide, with the dollar coming down, then you get into a situation where you have stagflation. Now, I think these 7 people on this board, all 7 are basically academics. I don't think they'll have any idea how to deal with stagflation. Just a guess, but we'll have to wait and see.
Okay. And it's funny you say that just because literally just as we're talking here, I pulled up the markets to see what they're doing. And there was an article here by about Michelle Bowman, who's one of the Fed governors. And actually, this was, I think, the first time since 2005 or so that a Fed governor dissented. Powell, the Fed chair, likes to have unanimity in the policy decisions, but she actually was arguing for only a 25 basis point cut, and of course everyone's wondering why why did she dissent? And she's saying here it's because the Fed's inflation goal has not been met, and she doesn't think that they should take basically their boot off the neck of inflation too soon here. So it sounds like she's likely worried perhaps about a stagflationary scenario.
Well, the other thing there too, Adam, Bowman is the only person that had any true banking experience. You have to go back in her history, you'll see that she had actual banking experience, which, everybody else, Powell has he's had Wall Street experience, but the other 5, they're academics. They have no idea what's going on Main Street. And so if you get into that sort of situation, I think that's what will throw them if you get into a stagflation piece in here. And you could see it yesterday after they announced, and the day before, how the rates tick back up some. Now, they may come on down, and they'll probably push them down. But the longer piece of that is that you push them down, and then they have to come back up eventually. You have to be on guard for that.
Okay. So maybe let's try to help people get a sense for where the puck is headed here. So we have been disinflating, and just to remind folks, disinflation means the inflation rate is coming down. It's still increasing, it's just increasing at a lower rate, right? And this is something you would expect to see as the economy starts to slow. And of course, this is what the Fed's been trying to engineer, this disinflation with its high interest rate policy and keeping interest rates high. So inflation isn't quite yet down to the Fed's target. It's close, right? By the Fed's measurements of it, depending upon whether you're looking at PCE or CPI or whatever, we're in the 2s somewhere here for the most part. But Ted, I actually put a tweet out on Twitter recently and just asked people, hey, okay, headline CPI is at 2.5% year over year. What has been the rate of increase in your own cost of living in your household over the past 12 months? And of course, as you can imagine, everybody came back. I think the low was probably like 8%. And then there were people who were 20 plus percent. So like these official numbers don't really match people's lived experience, right? So even if we got inflation, quote unquote, under control, the real cost of living that households are experiencing is still pretty high. So we could still have stagflation, right? In terms of like, yes, there's not a lot of inflation by the official reading, but for the rest of us, yeah, it really feels like stagflation, where our wages aren't increasing that much. Maybe the job market's really cooled off, but man, prices are still high and they're still not coming down yet, right?
That's true, but that's the only way, if you think about it, if interest rates are lower than the inflation rate, that's the only way they get out of this debt boondoggle, because they're not going to go the austere way. They're not going to go that direction. So that's the only way. If they could do that for 12 or 15 years, they would lower our debt to GDP, debt to government, and debt to GDP a lot. But I don't know if that'll happen either. But that's what happened for twice before in our history. So we'll see if it happens again.
Okay, but yeah, I mean, who knows? But I can see pretty decent odds of stagflation, at least on the personal
Yeah.
side of things, in the relatively near term here. You mentioned Lacey Hunt, and I know that Lacey, he's still in the deflation camp, right? He still feels that, from the metrics that he looks at, and of course, Lacey, he's an economist, so he is more on the academic side of things, but it's the great Lacey Hunt. I mean, he really understands real world knock-on effects. And, we shrunk the money supply at a rate that we've rarely ever done. And, I think Lacey is in the camp of like, you don't get away from that without having to pay the piper at some point. And so a lot of the data points that he looks at, basically says there's this deflationary wave that's been traveling our way through time via the lag effect, which folks have heard me talk about a lot in this channel. And I think he would probably say, and I don't want to pretend to speak for Lacey, but I think I could see him agreeing with that. Yeah, we may have kind of a period of personal stagflation here for a period of time, but then we could maybe go through a real deflationary period in the economy when that lag effect hits. And we're not even going to see any benefits from what the Fed's just done from this 50 basis point cut in the economy for at least quarters to maybe a year plus. I mean, that's going to have its own lag effect in and of itself. So while the markets are kind of cheering, oh, lower rates, everything's going to be great from here on, I think Lacey is saying, no, we might see, stagflation to deflation, and then maybe at some point down the road, depending upon what the policy folks do between now and then, a return to raging inflation. But that's down the road from here. What do you think?
Well, along that same line, I think what happens is when things, if things really get in the mud, they'll naturally lower rates again, because that's the only thing they know to do. They don't have any other policy that really has been that great, so they'll lower rates again. But the problem about this time around, and it keeps happening worse and worse and worse, is that when you're sitting with 35 trillion in debt, they have to get the rates down for the fiscal side, because the government, when you finance 15 trillion in treasuries the next 3 years that are coming due, they're coming due at about 175% over what they were. So they have to try to get the rate down, or they're going to really bust it. But I think what happens on the other side, just like you're saying, is that they push it, and you do the whole cycle again and the cycle again. But this time you don't have 9% inflation. Maybe you get 11. Who knows? But I think they'll make the same mistake over and over again.
Okay. And I mean, that tends to be the pattern of history, right? um, and so you bring up a point that's also worth talking about, which is 2 points really, which is with 35 trillion in that's just the federal debt, right? We're not talking private debt on top of that. And when you do, you start getting into the 100 trillion plus range. But when you have federal debt that's that big, it starts creating its own series of problems. And one that's manifested that most folks have heard about in the news is that the debt service ratio begins to really balloon, and it starts eating up a bigger and bigger piece of the national budget. And so this is the first year ever in history that the national debt service cost is going to be over $1 trillion, right? Um, so the Fed obviously is saying, look, we got to get the interest rate, we got to get that service cost down. We're going to continue growing the debt. So we really got to try to wrestle that interest service rate problem down. And the only way to do that is through lower rates, as you're saying. The challenge here is that, that debt continues to increase because of deficit spending at the fiscal side. And those guys they don't show any signs of slowing down anytime soon. And we've got two very different candidates running for president. And I'm going to ask you your thoughts on the impact of the election in just a little bit. But it really seems that no matter which side wins, their plan is still to keep deficit spending out the wazoo. So are we at the point of what they call financial repression? Or no, sorry, fiscal dominance, which is where basically the Fed kind of has to eventually give up its inflation fighting mandate because it just has to keep the debt under control. Because at the end of the day, if that's the linchpin that if it fails, it's game over for the central planners.
Well, we have to be, and that's one of the things I said early about looking like Japan. That's how they did this over the years. They kept growing, adding more debt, adding more debt, adding more debt, got the rates down to what, 0.1% or negative. And obviously in the end, it didn't work out today. But what was happening is that they kept adding, and the Bank of Japan ended up owning what, half the paper. And so, we could get into a situation. People don't realize how dire that can get if in fact you go into an area where things are really kind of coming apart, and they're already running, 6-7% deficits. I mean, we have had some of the worst policy out of the Fed and the government at the same time that we've ever had, and they're in a position right now to where I think they've already. I think the horse is out of the barn, and now they just have to deal with it, on a year-by-year basis and see what happens.
Okay, and this is where I sort of circle back to my earlier point of we can kind of guess at what the big decisions are going to be, but the exact pathway we take is, I'm sure, going to have a lot of twists and turns that surprise us. But it seems like from what you're saying, just the natural mathematical outcome is that the purchasing power of the currency is going to be what pays the price through here. And so as an investor, that's basically our priority number one here, right? Is to figure out how do we keep our wealth from getting eroded by this just continuous decline in the purchasing power.
Well, I think people have to realize, okay, if I'm going to own treasuries or I'm going to own corporate bonds, I'm going to own some sort of fixed income item, I'm going to have a position in gold side by side with that investment and call that gold sort of a bond proxy too. Because if you don't have that, what happens is as you inflate and keep inflating, you're going to get hurt if you own bonds that are very far duration at all. But if you've got something else that tends to go with it on the upside, then you're hedged to a degree. Now we don't own a lot of long-term paper, but that's really what I think people have to start to. They have to start to change the way they look at things over the next 10 years, because if you look at the commodity, if you look at the S&P commodity index relative to the S&P, or you can take Bloomberg, either one, they're sitting right on lows. I mean, it wouldn't be anything for us to have a lot of commodity inflation over the next 5 years, in addition to oil, gold, metals, a lot of other things. And you have to have that side by side. You can't be in the old camp, oh, I'll put about 40% in bonds and 60% in stocks. It probably won't work that well.
All right. Okay. So we're getting into the meat here of obviously where I want to go in here, which is how do you as a capital manager for clients, navigate all this. Let's just touch on bonds for just a second. So you said you guys at Oxbow don't have too many long duration bonds right now. I'm assuming that means of the bonds you hold, a higher concentration of shorter duration bonds. And there's been a ton of investor capital in the T-bill trade,
Right.
where people have been able to get, I mean, This has rarely happened in the past 15 years, right? Where you've had a place where you could kind of sit in safety and get paid an attractive return, and at least as measured by CPI, a real return, right? So you could be beating at least headline inflation in a very safe instrument, right? Now that the Fed has pivoted, right, and it's guiding that, hey, there's more interest rates to come, and you think the Fed's going to have to cut anyways as well, just to keep the debt under control. It's sort of saying, hey, we're declaring war on the T-bill and chill trade, right? Your nice, tasty, safe, short duration return is now going to start going away. So those investors are going to have to make a choice, right? Do I just ride this thing down, or do I start shifting it into other asset classes? So how are you thinking through that?
Well, I've told a lot of people, Adam, that if you look at the 90-day T-bill, okay, and we own a lot of U.S. floating rate treasuries, which is really the 90-day. And if you look at that, anytime you take the Fed funds down, you say they take them 5.5 down to 5, that means the 90-day is going to trade a quarter below that. So it's like today, it's 4 3/4. Let's say they take the Fed funds down another half to 4.5. That means you're 4 1/4 on the 90-day. That's actually still pretty good. If you think about if what they're thinking is that, okay, real rates, you can use what you want to, PCE, CPI, and none of those are necessarily perfect, but you can see where there's a gap between that. In other words, real rates are plus. So you effectively, you're still okay, I think, with the 4 1/4, which may be the next stop you see here. I think what people didn't do, and I saw this, gosh, I really saw this back in 1982, where rates were really, really high, 15, 16 points, 17, 18 for short paper, but the long paper was only, you go out 4 or 5 years, it was only 14.5. And they're like, why would I do that? Well, we had the same situation here. And for us, what we did, this is starting about 6 months ago, is we took a lot of the short paper and moved it 6 months, 12 months, 18 months, 24 months, still getting 5%, by the way. And that was the way we approached it. And then we did about 7% in the long bond, just as a hedge. We're going to trade it. We get 20, 25% out of it, we'll sell it. But that's the way we approached it. I think people will wait around, and then they'll get down in the threes and think, oh gosh, I need to do something. But see,
Right.
by that time, it's really sort of too late. I mean, it's not necessarily, if you can still keep things at 90 days or 180 days, but one of the hallmarks we've said of the next 10 years that you're going to have to be able to trade fixed income. You cannot buy and hold, because there's going to be periods when they run them down rates and they run them up, and you can't just sit there with it, because it's probably not going to do well for you.
Really interesting. Okay, so sounds like you guys have already taken steps at Oxbow to move out slightly in duration, still on the very short end, but going from 90-day, like you said, to 6 months, 12 months, et cetera.
We started doing that in March, April, May, and probably the last one we did was the first, second week in June. We could still get 5 even then on a 1 year. We couldn't get on the 2 year anymore, but we still kept moving out to where we were. So we ended up with, we ended up with something over that, basically call it that 2 year period, that would give us about a 480 or 485 yield locked in. See, so if they take them down, we're okay. If they take them up, we're okay, because we'll have paper that's coming due. See, and that what you try to do in this business is make sure you're okay either way.
Right. Right. And I guess my only question is as those start to come up for maturity, if the Fed is continuing to march down here, do you expect it all to bring that further out in the duration curve? And I'm not talking the long end, but like, between 2 years and 5 years.
Yeah. I don't see us going, Adam, much past 2 to 3 years, because once you get to the 5 to 8 year or 5 to 12 year, then all of a sudden you start taking price risk, because when they move the rates on you, then the price of and
right.
It's one thing to have to wait a bond out for 36 months, but it's another thing to wait it out for 5 or 6 years. It will feel like 5 or 6. And that's the way we would look at it at a time, and probably not go much further than 24 or 36 months. And, when rates were down at a quarter of a point and stayed there for so long, we we bit the bullet and got a lot of heat for staying short because we were only making like a point, but we were making more than most people were, but we were short. And we ended up not losing much money at all when they pushed the rates, which was a positive for us. But we took a lot of heat. We took a lot of heat during that period because we would not extend the maturity. But people that did, they really got hurt.
So you're raising a great point. I just want to underscore for folks here, which is I'm painting with a broad brush here. Not Oxbow is not included in here, but financial advisors tend to hate being in cash for their clients because there is a prevailing point of view that, well, clients can be in cash, on their own. So, what do they need us for? And I definitely beat the drum to say, hey, you're paying your financial advisor to know when to be in cash, right? Cash can be a very sensible position under certain circumstances. And so you want to be paying for the experience of your financial advisor to say, hey, I moved you or part of your portfolio, whatever, to cash for the foreseeable future for this reason, and these are the conditions I'm looking for to reinvest it. That's expertise, and that's definitely worth paying for. And the example you mentioned here, because I remember those days, right? I remember, some of the financial advisors that Alpha Money refers to had a similar strategy, and a lot of times, people were getting crushed up until rates took off, right? And then people who were way far in duration, they just got clobbered, right?
Oh, yeah, and still clobbered to this day, if you want to know, because they're probably never going back to that level. So, you're good unless something really unusual happens. But I mean, that's where they are. Same thing happened to the banks, by the way. So that's exactly what happened to them.
Banks. And so I just want to say kudos to you and folks. I think that's a sign of a good financial professional to work with. If they have the courage to tell you, hey, I think the best thing to do right now is just to have some dry powder. It's a risky position for them given how it's treated in the industry, but they've got the courage of doing what they feel is right. So anyways.
Right.
All right. So I want to ask you about stocks as well, and maybe if we can get to that question through the consumer. First off, we are seeing that the jobs data is weakening. Jobs market data is weakening. Now, Powell would not say that. He would say it is normalizing. But if you listen to the many journalists who were there at his press conference last week, they were worried, right? And understandably so. And I think both you and I have talked a lot in the past year and a half, Ted, about how if you looked under the hood of the headline jobs numbers, which were always rosy, but then revised down at the following month, you could find a lot to be worried about in the jobs data. And I think the market is finally waking up to the fact, and the Fed probably waking up to the fact that the jobs market is not as hale and healthy as it's been sold to us for the past year or so. As I said in the intro, like it's pretty hard to not see signs on a daily basis that the consumer is continuing to weaken and buckle under the high cost of living, especially as the job market cools off here. Now we're a 70% driven consumer spending economy here. But at the time we're talking here, the Buffett ratio, which is a measure of stock market valuation or overvaluation or undervaluation, is at 200, which is basically tied for a record high level of overvaluation here. So it seems that there's a pretty big disconnect right now between the party that's raging in the stock market and the health of the underlying consumer base that is supporting the economy that the stock market is pricing itself off of. How concerned are you about current levels of overvaluation in stocks, and how do you think, or how are you treating stocks right now in terms of how much client capital to be allocating there right now?
Well, we in a stock account, which is all common stocks for us, we're about 54, 55% invested. We have about 45% in treasuries, not because we wouldn't be fully invested, but we're somewhat talking about Buffett. We're somewhat like Buffett. You can't find the buys and you don't take them down. And so that's what keys us to what we do. We run valuations on about 250 companies. And those, if something doesn't hit, then we can't, we don't buy it. But where we are right now, that feels right to us right now. We have a lot of profits and stuff that we've had as legacy stocks that we wouldn't necessarily buy for somebody today. Like we have bits of Apple and Amazon and those kind of stocks and a lot of Microsoft left over the last 15, 18 years. But we cut a lot of them back. The new buys for this year have been defensive. They've been consumer staples. They've been healthcare. We bought utilities, and not in big lots or anything. You can obviously tell that by only being 53% invested on average. But I think that's what people have to be aware of. If we're in unstable markets, and by unstable I mean unstable up and unstable down, and that means that yeah, you could get movement on up where people just keep on chasing the prices higher, but they're not values. Look at one of the things you can look at sometime is look at the cash value in Berkshire Hathaway, cash in Berkshire Hathaway relative to price.
Mm-hmm.
It's at an all-time high. And so what that's telling you is that, not the Buffett indicator, but this is just how much cash they have. And so you're just not seeing the things that people want to own. And for us, we have to have an outlet, because if you look at everything that's going on, going to have a new regime, after January here, worldwide conflict. There's so many things could happen that, if you don't have a buffer, we think, of some liquidity, then you're not going to be able to live to play another day. And that's where we are right now.
All right. And, Ted, you and I have discussed this in previous interviews, but you have had a long career managing client capital. You're also a student of history. And so, you know what a bull market looks like, what a bear market looks like. I don't want to put words in your mouth, so please put your own words in your mouth here, but it seems from talking to you today as well as previously, it seems like we're seeing a lot of hallmarks of kind of a late stage bull market here, where the market has kind of decided that fundamentals don't matter. It's gotten comfortable bringing valuations up to ratios that are extremely stretched given historic means. And it seems like the type of stage that precedes a material correction. Now, how long that correction takes to manifest, that's anybody's guess. But am I characterizing this correctly?
Well, you are, and I would say again, it's complacency. When you haven't had anything really bad happen in the last 15 years. I mean, let's face it, we had a 5-week bear market in 20. In 22, we had 9.5 months, and then everything's over. You go back to new highs, and everybody's like, nothing lasts very long, so don't worry about it. Stay invested. Everything's okay. I think the average investor is not even looking at what they own. I think the professionals in my business have just put them in so many ETFs and indexes. They think everything's fine, have no idea what's in them, no idea what's going to be. But, one of the things I find about bear markets, and that people have totally forgotten, by the way, is they come quickly, and they don't have to crash, but they come quickly. And you look up and, in 4 or 6 months later, you look up and you're like, man, we really come down a lot here. And then all of a sudden people lose complacency and start really worrying about it. But the biggest thing here is that you have a situation where people are complacent, prices are high, and that in itself is a recipe for some pain down the road. Maybe not in 2024, but I think eventually you get it. And I know a lot of people say, well, you didn't like the market a year ago. I liked the market. I liked what we owned, but I didn't like everything. And I think that's the difference between people that know value and people that don't. Now, you can't just buy anything. And we're still sort of in that mode today.
Okay. I remember talking with you near the end of 2022, where, it was not a good year in the markets. But I remember you saying, yeah, but this isn't like a bear market washout, that, historically by the end of a bear market, nobody wants to touch a stock again. And even though, folks were getting worried by October of 2022, correct me if I'm wrong, but I think you were still having more people sort of asking you, well, is this the bottom? Should I jump back in?
Right.
Right. It didn't break that complacency in the overall long-term upward trajectory of the market. So it sounds like, you're expecting at some point here, and of course at some point it'll happen, but that, we will have a true bear market that will come on quickly. It'll break that complacency, and we'll kind of know that it really is here, and maybe even getting near its end at the time where people are just like, don't even talk to me about stocks. I don't even want to look at another stock the rest of my life. Correct?
That's true. What happens too is that I'll give an example. If you look at October 22, see, we didn't have any margin sales. There weren't any margin calls. Nobody was selling because they didn't have to. You didn't go down far enough to get all these margin calls. So it's usually when you get margin calls and debt goes back, there's a lot of things blow up at the same time on those kinds of markets. And one of the things we have now is that I don't think people think that that can happen. And so when it does come around, then you test people's mettle on how they can handle volatility, because that's a big factor in here. Because a lot of this money in the market are boomers, and they're not youngsters, okay? And they're out spending money. I tell you, they're spending a lot of money. The boomers are, but I think they think they're rich to a degree because their stock prices are up.
Mm-hmm.
You let that change all of a sudden, and that is a big twist, and that's a fly in the ointment for sure.
Yeah, that's we talk about the wealth effect, and that's obviously something that the Fed chair is always trying to, increase. But, a negative wealth effect has a really big impact as well. So one of the reasons why I'm kind of probing around this, Ted, is look, I wouldn't classify you as a bear. I would classify you as just a pragmatic investor who's got a lot of client capital and is trying to figure out how to get at the best return, with an acceptable degree of safety, through all this. But I'm beginning to see again, as the markets are hitting new all-time highs now. I'm beginning to see comments from people saying, "Hey, Adam, the guys on your channel are just all bears, and isn't it time for them just to admit that they're wrong?"
Yeah.
Right. And I, to be honest, I understand the spirit of the point, which is like, hey, you guys have been raising concerns that maybe, intellectually sound valid, but hey, the market's done nothing but, had a fantastic year so far. And that's on top of another really good year last year. So, what would you say to that person?
Well, I would say to that person that if I could take them back with me and I could go back in time and start them at about the last quarter of 1998 all the way up to about April of 2000, they would think the same thing. Matter of fact, you would get run out of people's offices if you said anything negative about the markets. People are like, hey, you've been saying this for a year now, a year and a half now, and it never happens. Well, what did happen is within a year from that time, the pain was in, and then it just kept on going and going and going. And I understand what people are saying. I understand that, but they're thinking in an all or none mental attitude. You can't think about that like that investing. It's not all or none.
Mm-hmm.
You have your hard-earned capital at risk, okay? So do you want to put it all at risk to say, okay, you know what, the market's great, and we're always going to be in the market, and it's great. But for people over 65, which is where the bulk of this money is, they can't do that, or they shouldn't do that, because they can't go back and earn it again. And you'll have a lot of things happen in that group, I think, that will be affected by staying so bullish. And I've got people 80 years old, have 85, 90% in the market that come to us. Like, we have to almost get into not an argument. We have to say, hey, look, you're not thinking straight here. Yeah, you made a lot of money. Yeah, you made a lot of money over the last 12, 14, 15 years. But you know what? How much? I asked a guy this last week. I said, how much do you think the S&P is up from where it was July the 6th or 7th? He said, I don't know. I mean, it keeps on going. I said, no, it didn't. It's even money. You're not looking at it. And that's what I'm trying to say is people on the outside, and a lot of practitioners, they're not realistic about what goes on with somebody. Because I will tell you, I've told people this for 30 years that worked at Oxbow. People will tell you for the rest of their lives that, hey, I'm long-term oriented. As soon as they lose money, they are short-term oriented.
Yeah.
I promise you. And that's what happens.
All right. Two points on this. I guess I'll go to this one first. before we turned the camera on, you were telling me about Galbraith's book, The Crash of 1929. And if I heard you correctly, it sounded like you were thinking that book could almost be written today, correct?
Well, the point I was making is Galbraith wrote and it's a small little book, and I'm not trying to scare people. I'm just saying you look at periods of euphoria, okay, and he wrote another great book on market euphoria, but doing this one, he wrote about 1920 for the next 10 years and what built up to that. And if you just close your eyes and just heard it and didn't know what year it was or anything like that, you would think it had been the last 12 or 14 years here, because everybody was there, everybody was hailing the market, even Washington. Nobody thought, you remember the comment, we're on a perpetual high, in
Yeah,
the market. That came out of
perpetual
Washington.
plateau. Yeah.
Yeah, it's like, and then all of a sudden, and this happens a lot in bear markets, nothing really happens. Sometimes they just start selling, like 2000. They just started selling off in April and May. And then they sell a little deeper and a little deeper, and then you get a little rally and they go deeper. And everything still looks okay, but the pricing's not good. And that's really what that book was about. But it was a good read because it tends to at least sober you up a little bit to say, things are not always that way. And he wrote another great book about the attitudes of people in times when everything's flourishing, and what's the number one error that they make. And you know what the number one error, he said, was they don't have any memory. They can't remember. And he said that you get on the road for 6, 7, 8 years, and it's like never happened. Well, and then something always happens. And I'm not trying to say you just go all cash, but you have to invest to be able again to play tomorrow, and that's a real important point.
All right. Yeah, as one of our other endorsed advisors like to say, you don't just retire for a year or two, you retire for the rest of your life. So you want to make sure that your money's being treated in a way where you can do that, right?
Yeah.
All right. The other point I just wanted to make is to just reference a chart that Jesse Felder was talking about, and I was highlighting in my interview with him earlier this week. There's no silver bullet. There's no single indicator that proves give us 100% confidence of what's going to happen next. But Jesse said that if he could only sort of navigate his investing strategy by one indicator, it would be the 12-month insider sell to buy ratio.
Yeah.
And it is back at extremes that it has rarely hit before. And when it has hit those extremes, there has been a pronounced earnings recession over the following 12 to 18 months, which makes sense, right? It's basically insiders know more about the company than anybody else generally. And if they start selling their shares at an accelerated or an extreme level, it's generally a sign that they think the future of the company is not going to be as good as what the past has been, right? And that's what it's telling us right now.
Well, it is. And I think you have to stop and think about that just a second. If the dollar's going down and everything we import for companies to build inventory with means it's going up, that means the margins are going down. And I think they see that those margins will be down, which means the price will be down at that point. And they probably factor in a bit too, just politically, they look at it, and one of these parties really obviously has said, we're going to really, really raise the taxes on capital gains. And maybe they're looking at it like that too. But usually when they do, I've found them to be okay. But as an indicator, though, they have to be at extremes, extreme buying or extreme selling. And then you've got a good indicator. In the middle, when they just go back and forth a little bit,
Right.
It's not a good indicator. But when it goes to extremes, you can look at it hard.
All right. Well, so here we get to where the rubber meets the road, Ted. You have billions in client capital under your team's stewardship there at Oxbow. And you've got to try to navigate that through what you see coming as best you can within the confines of what you think the right risk return ratio is. So, what are you doing right now at Oxbow with your allocations?
Adam, I may have told you this. I think I showed you this a couple of years ago. We had this idea that instead of 60-40, it was going to be a 30-30-30-10 sort of look.
Right.
By that, I meant 30% you had to keep in short-term fixed income, not long-term, but short-term, and trade it. Okay. And that 30% had to be in real assets. In other words, commodities, real estate, things, real assets. And you needed that growth wouldn't necessarily be the leading factor because of what would go on with a lot of things that were unstable. So it'd be more of a growth value situation. Then you'd have 10% cash. But in all of those categories, outside of real assets, you would have to trade those from time to time. You couldn't just do 60-40 and sit on it. So for us, if you look at it, we have three pockets of money. We have real short term called conservative fixed income. It's rarely goes off at all because it's so short term. Nothing happens to it. Then we have in the middle, we have a high income account. And in that high income account, we have a lot of commodity exposure. We have gold, we have miners, we have fertilizer, we have real estate. We have a lot of things in there that we wouldn't have in the other two portfolios necessarily. So that's where we catch that category of real assets. We have real estate in there as well. And then on the stock side, we shifted, but we have a lot of energy now. We have more energy than we've had in a long, long time. I think there's a really big chance that something in the Mideast is going to interrupt the energy flow. And when it does, you want to be in those companies. But then we have gold miners in the stock portfolio. We have a lot of consumer staples, and we have a lot of healthcare. I mean, healthcare demographically is somewhere you want to be, and it got really cheap in the last 6 or 8 months. But if you put it all together and then you take the liquidity side, let's say across the board is about 50% in treasuries, we think we're okay to basically work through any storm. I'm not saying we wouldn't come off at all if you get into a super bear market, but we wouldn't come off that much. And so that's how you have to look at it, I think, going forward.
Okay. Fantastic. And thank you yet again for being as transparent as you just were in terms of how you're allocating your capital there. Get a lot of just regular retail investors watching this, and to be able to sort of peer over your shoulder and see what expert like you is doing, Ted, is super valuable to them. All right. Well, look, as we begin to wrap things up here, I know the past couple of times, Ted, when we've talked, we've kind of veered into sort of your backstory and your approach to how you deal with clients, because you grew up from a not wealthy background at all. In fact, I think you even declared it as an impoverished background. You're highly involved in philanthropy. You definitely, have taken the success you've had and used to give back to the community. Before we turned on the camera here, you were sharing that you actually had just watched the video that my wife Ashley and I filmed earlier this week about basically best practices for cultivating healthy relationships in your life. And something I've been mentioning a lot in this channel is that, look, money is we have to keep in mind that it's important, but it's a means to an end, right? And what really does matter in life generally falls into one of three buckets: quality relationships, purpose and meaning, and then health would be the third one. And it sounds like you very much take that to heart. And I guess I just want to give you a little platform here, because you work with families, you work with them oftentimes over the years, the decades, and see what really truly matters for them. So, as you counsel people to, yes, focus on the money side of things, where do you see the most important success that people have in being truly wealthy in their lives?
Well, I think we're the people that feel the most wealthy, definitely do things to give it back to the world, give it back to the community, because that's, in the end, that's the only true legacy. You can put your name on a building, but what really, if you change some lives, our big thing here is we have two major foundations in Texas that have foster kids that really I founded. But the point of that is that if you change their life, then you've really changed the world, because that means that their kids and those kids after those kids will probably change a lot. When I'm talking to people with that, especially people with a lot of money that sold a company or something, I said, one of the things you need to think about is this, and you need to think about what kind of relationship you're going to have with your kids, because now you have a lot of money, okay? So you can make life really easy for them if you want to. But I said, here's a better approach for them. A better approach is to let them go out and have to hustle in the world themselves. And then while they're doing that, show them how you can give back to the world, maybe just a little bit if you're just out there on your own. And some of them do it and some of them don't. I think they regret that they don't. But I asked a fellow the other day that wanted to bring a couple of kids back in a family office. I said, well, look, let me ask you a question. I said, if you've hired people in your company and all sorts of things all your life, I said, would you hire somebody who had zero experience? He said, no way I would do that. And I said, well, why are you bringing your two kids back in? They've done nothing. They got out of college, okay? Put them on the street for a while, 5, 6, 7 years, and they'll learn more like that and then come back and really appreciate it. And then you can teach them that, hey, we have this money, but we're not just going to use it for the money. We're going to use it for the good of the world, and then you can do something with it. If you don't get started on a good footing like that, I don't think you'll ever get the right idea across. Some people listen to us, some people don't. And by the way, it's their money. They can do whatever they want to, but that's the way we look at it.
I just think that's such a wonderful way to look at the world. And I completely agree that if you really want to make a difference, the way to change the world is by changing lives. And I guess the one thing I want to underscore and would love your thoughts on is you don't have to be a multimillionaire to do it, right? Sure, if you have a lot of money, you can impact a lot of lives. But I mean, I remember as a college student, my freshman year, I started supporting a child. I think it was through UNICEF or through one of those organizations down in Colombia. And I mean, I think I could send, I don't know, 10, $20 a month down there or whatever. I mean, I was a starving college student. But I hope made a big difference in her life, and she sent a lot of nice letters, over the years. But I think for me, it really underscored that, I can make this type of legacy difference, even if I don't have a lot of resources. And of course, even if you have no money, right? You can basically tithe with your time, right? And volunteering and helping people out in your local area. So, anyways, I think that's,
Well, I think people don't realize that, though. I know I did grow up extremely poor. I always had to have 2 or 3 jobs. And I mean, we had nothing. I mean, when I say nothing, we had really nothing.
Like no indoor plumbing, I think you mentioned at one point, right?
And no water. We had a water well. But the thing about it is you have to be, what I did is, even as a kid, all my time growing up, if I saw another kid or somebody else that, I didn't have a lot of money, but I would give them a quarter or I'd give them 50 cents and say, hey, you spend that. And as I got older, one of the things I found out about giving to people and taking care of things is that you'll never miss it. I promise you, you'll never miss it.
All right. Well, look, I can't think of better perspective to end on than that. Ted, for people who have really enjoyed this discussion and would like to follow you and your work, where should they go?
Well, the best place, Adam, is oxbowadvisors.com. I mean, we're really transparent. We don't try to hide a lot of things, and we're simple in our approach, but you can see it all there. A lot of books there. You'll see everything we do, market letters and various things. So just come to the website, oxbowadvisors.com. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.